Hello, everybody, and welcome to Traditions Going Vertical podcast. I'm your host, Mike Greenlay. As usual, I have my co-host, Erik Hendrikson, president of Tradition Mortgage, alongside. And it's our pleasure to also bring in Brad Carlson, who's a VP and partner with Tradition Mortgage, to join in the fun. And, maybe we shouldn't call it fun because this past week has certainly seen a lot of ups and downs in the wrong categories, I guess we could say. So, Erik, why don't you give us a synopsis of what's gone on, and we can kind of break down afterwards, where it goes from here.
I think you'd have to be living in a cave or at least living in a home without internet connectivity to have not known that the Federal Reserve met this week and they adjusted the Fed funds rate and moved it upward again. There was a lot of debate in the investor market as to whether or not it was going to be 75 or even 100 basis point increase, of which either one is one of the largest single increases that you're ever going to see. We just did come off of another 75 basis point increase back not too long ago here, so kind of two back-to-back in just a little over a month. But they came out and 75 was the decision, and really furthermore, they talked about how they were going to continue to move the rate upward, and they were bound and determined to stomp out inflation, and they talked about even 125 basis points more before the end of the year. So 75 was expected, but this whole 125 basis point additional move before the end of the year really sent things just kind of into turmoil as far as the bond side of the market, and even the 10-year Treasury, which is viewed as a close proxy to mortgage rates, is up 100 basis points from a month ago. So a full percentage, which is just crazy. Normally you just don't see that kind of volatility in the bond market, or certainly in the Treasury markets. But it's inflation is real, and I think they're coming to grips with the fact that the Federal Reserve is going to take a tough stance, and this isn't going to be an overnight situation. And how does that relate to mortgage rates? I think there's a lot of confusion as to, when the Fed moves rates, people are like, does that mean they moved mortgage rates? No, they don't. The Fed funds rate is a very specific rate that deals with interbank borrowing overnight, short term. So it really directly has nothing to do with mortgage rates, but it is very much used as a proxy as to inflation in the direction of overall rates in the marketplace. So it does have an indirect impact, and you did see home loan rates move up significantly on the news, up probably a quarter point in the last day, and it looks like based on trading activity here at close to 3 o'clock on a Thursday, we might be up another quarter. So we're really pushing towards the upper limits of the sixes for your typical 30-year fixed rate, almost to 7, which is we haven't seen that in close to a couple decades, believe it or not. So, just a little bit going on in the mortgage market.
Brad, as someone who understands the operations side of the mortgage and every other side for that matter, how are you seeing this affect obviously with the mortgage rates, but the mortgages in general and the mortgage business as a whole? Obviously, people are trying to project out, what they want to wait for and what they want to do now, and I'm sure that there's a lot of people scratching their heads.
Like Erik mentioned, we haven't seen rates this high in a couple of decades now, and I think for people that especially are getting into the home buying, the first-time home buyers, obviously I think they're seeing a shock on where rates are today. And, like Erik kind of mentioned is, we're probably getting to the end of the rate hike. And it comes back to, everybody's seeing it. Everybody's nervous. The cost of a home is going up. And, one of the things that, we're focused on with our clients is focus on the payment. And if the payment works, this is probably going to be the height of the payment. And at that point, down the road, at some point we're going to see these rates, jump back down, which, at that time, we're going to be here to help and serve our clients. So there's definitely some concern and definitely some thoughts going out there on people on what, now a good time to buy a home. And, for us, we believe it is. And, again, if you can handle the payment and the payment works for you, for us, it's it's this is probably the height of where we are at rates right now.
Speaking to that a little bit, typically a home price is there's kind of a teeter-totter where the lower the interest rate, the higher the appreciation capabilities of the house for affordability, and as those interest rates move up, typically that puts a lid on the appreciation element of the house, or even brings it down a little bit, so the actual kind of affordability maybe stays in balance. And I do think that there's a lot of people tapping out right now that are qualified buyers that just look at it and they say, okay, they saw where interest rates were and they're seeing where houses have gone. They're like, we're just going to wait for a while. So I think as those people temporarily pull out of the market, it puts less competition on the houses that are out there, and people can actually buy. And it is, ironically, for first-time home buyers, we've had this discussion with several loan officers, is actually buyers are having success getting houses now that are first-time home buyers, because the biggest challenge was when rates were low and the housing market was going crazy 2, 3, 4, 6 months ago. It was all cash buyers, investors. Everybody was scooping up these houses, and if you have a government pre-approval, sellers are like, I don't want to deal with it. The FHA, VA, they have very stringent guidelines as far as quality of properties. There might be a list of items a seller needs to rectify before the property can be sold, and of course the seller's like, I don't want to have to do any of that stuff. A lot of people were selling because they had deferred maintenance, and they just were like, they wanted to move on, and they just want to be able to get a check and hand over the keys. So now that there's less competition for properties, a first-time home buyer coming in with a government loan pre-approval is actually able to get the house. So yeah, they're having to pay a higher payment associated with these higher rates, but it actually gets them into the house. And just like Brad said, even though the Fed funds rate isn't at the top yet, mortgage rates, they operate on future expectations, as does the longer bond market. So if the Fed is expected to move another 125 basis points up in the future, the home loan rates, the 30-year fixed rates, they price that in immediately, and that's where we've seen this adjustment. So the rates we have today, as we speak right now, reflect that move already inside of the rates. So we are, what we believe is very much at kind of the top end of the roller coaster here. So if somebody does buy a house, and as long as they stay employed and they maintain their credit, as these rates do come down, as inflation gets under control and potentially a little bit of a recessionary environment, there's a very, very high probability they'll refinance into a lower mortgage, could be as soon as, 6 months, 6 to 12 months.
And during these times where, I don't say unique things, but definitely things that we either haven't seen in a long time, or for some people haven't seen them at all, there are new terminologies, new words, new ways of thinking of things. So I know that we've discussed this a little bit, and you've brought up a couple of terms that are being used these days, whether it's the banks or whether it's mortgage companies or whatnot. But I think you're talking about things like terminal rates and stuff like that, and people probably need to know what that means, because your average guy on the street probably doesn't understand what that is.
Terminal rate is a kind of a fancy term, but that is basically just the projected high end of where the Fed funds rate's going to go. And when the Federal Reserve came out with their kind of post-meeting statement yesterday, they did surprise the market and said that, hey, we moved 75 basis points today, which is a huge move, but we're looking at, with a slight asterisk, but saying, hey, depended on some variables, but we're looking at going 125 more basis points before the end of the year. And I was like, wow, okay, that's a huge move. I mean, these moves that the Fed are doing with bumping up the Fed funds rate, I mean, typically you'd never see more than a quarter, and it's spread out over a long period of time. So to have these really significant moves, what they're trying to do, I think everybody needs, like, what's going on here? They're trying to get people to stop buying so much stuff using credit, because this Fed funds rate, although it does have an indirect impact on mortgage rates, but where more specifically it hits home equity lines of credit, credit cards, more consumer loans, auto loans, those types of things. That's vastly more expensive. So if your credit card goes from 8% interest rate to 15 or 16 and you get that bill, you're like, well, maybe I don't want to put going out to dinner on the credit card or going on that trip with, the plane tickets that cost twice as much as before. So, consumer demand using credit is going to, I think, take a major hit here. And with them forecasting out another 125 basis points, they're sending notice to the consumers out there, hey, if you're thinking to borrow on credit, think again, because more of this is coming down the line. Our terminal rate, our top end, is not done yet. So I guess it's something that everybody needs to be cognizant of. But again, mortgage rates do take that into account, and they kind of reprice instantly, kind of looking at what that terminal rate's going to be in the future. So that's a term that doesn't get thrown out too much, but boy, you're going to hear a lot of it here coming up in the next few months. So Brad, I have a question for you as it relates to kind of under the hood here in the mortgage company. You got your finger on the pulse of the pipeline. You're in there every day looking at these individual loan files, helping our loan officers out. Rates have gone up tremendously. We have huge pipeline of pre-approved buyers that haven't found a house yet, or people that are just in the process of signing purchase agreements that haven't locked. Working through that, are you finding that, is this putting people on the red line where they're bumping out of qualifying? Because that's, the first thing you think about is, man, if you're stretching a little bit to buy a house because prices are up and then all of a sudden interest rates are up and you haven't locked, are you feeling like we're kind of, is it code red, or are clients, nobody likes a higher rate, it's uncomfortable, but do you feel as though, the approvals are still there, and maybe, are there any other issues that you're seeing, or maybe some silver linings through this as well too?
That's a good question. On the backside of things, what we're seeing right now is obviously as the rates go up, the cost of a mortgage is going up, which is increasing the qualifying. But like we were talking about here, it's not all doom and gloom. Where we're sitting right now is that we're seeing the inventories grow, where before it was a heavily weighted seller's market, and it's still a seller's market out there. But as that inventory continues to grow, and for the clients that we have right now that are pre-approved, they're finding more options to buy right now. And so instead of being pigeonholed into maybe one particular property or maybe a pricing point that they're not super comfortable with, they have other options right now with that inventory growing. So on that question of, are we seeing that affect our buyers qualifying? In most cases, we're not. In most cases, they're able to absorb that payment. And a lot of it's because the inventory's growing a little bit, so they got more options and more pricing points to choose from right now.
Yeah, that is a good point. The one frustrating thing we'd see as a mortgage company, and we're not alone, other companies, you constantly see more and more clients call you and they want to get pre-approved and they want to look for houses, so your pre-approved pipeline keeps getting bigger and bigger and bigger, and they're not converting over into actual locked loans moving to closing where someone has a property. They're just, again, there could be 4, 5, 6 failed attempts at a purchase agreement, and then they may give up. So, you're doing all the right things as a loan officer. You're getting these people to come to you. They want to do business. They just can't get a house. So now, and we got these attractive rates, but now the rates are let's be honest, not quite as attractive, but people are actually finding more attractive options for different housing. So it is kind of a silver lining out there. And I can say, despite a lot of tensions in the office this week as you walk around and everybody's staring at CNBC and they're listening to Jerome Powell give his speeches and all the follow-up, which is certainly stressful. But the phones are ringing, and we're actually locking in more loans. More people are finding houses this week than probably the last several weeks that we've seen on average. So, just kind of amazing how it works out in the end.
That's also a lesson that we've harped on a few times, and that is there's more to buying a home than one number. Right? I mean, we've talked about you guys talked about the inventory, you talked about home prices, you talked about mortgage rates, you talked about other rates that affect all those numbers. So the point is that there's always another way to do something. There's not just one way, and that's what you guys do. You guys help people find another way to either educate themselves about it, or look at it, or react. And so part of it is, what do you do going forward here, and what are some of the messages to people You said not a lot of doom and gloom, but is there any other message that you give people to say, hey, you know what? There's other ways of doing things.
Well, it's maybe not necessarily other ways of doing things, but there's a bigger perspective that you got to look at. Some people get pretty myopic and they focus on just one thing. They just, okay, what is the interest rate per se, and that drives everything. And it's not. That's just one part of the overall formula. And I think you got to look back up, look big picture, and say, okay, number one, can I afford it? Am I in a financial position where I can afford it? At the end of the day, that's a huge thing. And then, from a standpoint of your life, if you're someone and your family's growing and you need a house, and I mean, time goes by quick. You can sit around trying to wait for the perfect time to do things, and life passes you by. So I think you got to say, okay, am I at the point in life where we really we can afford it, and we need to have a house, and we're ready for it as our lifestyle. And then again, right now where again, people are a little bit scared and more inventory is coming out, there's maybe an opportunity where you can actually maybe get a reasonable deal on a house again, where it's getting to more of a balanced market. And then remembering there's all, people have all these cute little phrases. You can, you marry the house and you rent the mortgage or whatever. But the bottom line is rates will come down, and they will come down significantly. How much and how soon, that's what we don't know, but it will. So there's going to be opportunities to lower that payment out there. So as long as you can, it may not be your ideal mortgage payment, but as long as you can afford it and it's, prudently reviewed and underwritten, you just got to look at those overall pieces and just kind of step back a little bit on it and say, okay, 5 years from now, 10 years from now, where am I going to be? And is this the house that I really see myself being? And I this is your opportunity to get it. If you're waiting for all those other elements to be perfect, you may not ever get a house. So those are just the things that we try to educate. It's all about education and perspective, and we really try to, give that information to our clients so they can truly make the most educated decision.
Well, a lot of good points there, gentlemen. Brad, once again, thank you for joining us. A pleasure to have you on board here, and of course, Erik, good to have you alongside as well. And we will come back at you with other topics and other issues as they arise here week to week. So, thank you both for joining me.
Thanks, Mike. Appreciate it.